Today, Texas reports a record high number of coronavirus hospitalizations after being one of the first states to open back up. Also, empty sports stadiums across the country threaten city budgets. And finally, we break down the latest trend sending some stocks soaring higher: bankruptcy. I'm MacKenzie Sigalos, and this is CNBC After Hours. Let's take a look at how Wall Street did today. We'll start with the NASDAQ, an index that includes a lot of big cap tech stocks. Think names like Microsoft, Amazon, and Apple. The NASDAQ closed today's trading session at a record high, just the latest milestone in the stock market's lightning-fast recovery from the coronavirus-related turmoil earlier this year. Now, not all stocks finished higher. The Dow handed in its first loss after 6 straight days of gains. And I want to highlight 3 specific stocks that fell double digits today: Hertz, Whiting Petroleum, which is an oil company, and J.C. Penney. All of these companies have recently filed for bankruptcy, so it makes sense their stock prices dropped today. But here's the thing. They dropped today, but they're coming off of jaw-dropping runs higher in the past few weeks. Take a look at this. All 3 of these, I'll say it again, bankrupt companies, have more than doubled in the past week. Hertz is up more than 300%. This doesn't seem to make any rational sense. Here's just a taste of what CNBC heavyweights Jim Cramer and Brian Sullivan had to say today about the phenomenon.
There's a lot of people who are running stocks almost as if it's some sort of like a big game. And that game does not last.
Betting. This is not investing. This is gambling. I know I'm editorializing. I don't care. That's the reality.
Okay, so they called it gambling, playing games, but the stock market isn't a game. There's real money involved, money that people could lose. CNBC's Dominic explained to us exactly what's going on here.
So one of the craziest parts about the recent market rally that we've seen is this notion that a lot of traders are starting to pile into stocks that are already bankrupt. And one of the reasons why is because they're trying to see if they can find some kind of a pop in return. Some of these stocks have traded for beneath $1 at some stage during this last few weeks, or to very depressed levels. And what they're hoping for is that if they buy the stock can pop by some exorbitant amount, and then they can try to get out of them. And so there's been a huge chase for many of these distressed names, these bankrupt names, because traders, at least some of them, are just trying to see if they can get that really, really quick flip in return. So we've started to see a little bit of data that suggests that a lot of the trading that's being done in many of these bankrupt or near bankrupt type names is being done on the retail side of things. That is to say, non-institutional traders that could be just regular old traders at home, the real professionals. And we're talking about hedge fund titans like Carl Icahn, who has been a hugely successful investor over the years. And even he decided to get out of a company like Hertz, given the fact that the company's in bankruptcy right now. The idea that there are some traders out there who are benefiting or are profiting from some of these moves to the upside doesn't really reflect some of the institutional view, right? So most times when you have a bankruptcy, a formal bankruptcy happen, there's very little chance that the stock or the equity itself is worth anything. So what you are seeing now is a scenario play out where people who are trafficking and trading in these types of bankrupt or near bankrupt names are betting that when they buy a share, somebody else is going to pay even more for that share down the line. So it's kind of like a self-perpetuating prophecy. The issue is, at some point, if the equity or the stock is determined to be worth nothing, all of that collapses to nothing, and you don't want to be the one holding the bag when everybody else is already out of the stock. Most times, a stock will not be worth anything after a bankruptcy. It depends on a lot of things. The negotiations that happen with bondholders, the lenders that have lent these companies money, they're the first in line to collect any kind of money that the company can pay them back. And the last ones that get paid back are the actual stockholders.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves today.
Clearly, the bounce back and the magnitude of it has been a surprise to me. We've still got a troubled economy. We're finding our path back from COVID with the opening up of the economy, and I think some people are interpreting opening up to the economy being great, but that's clearly not going to be the case for some time.
I would like to be able to get more money to buy more Tesla, actually. I thought that we would make 20 times our money in Tesla. So far, we've made 4 times. I now think we're going to make double or triple again over the next 5 years, and double or triple again over the next 5 years. I think there's 10 times more to go in Tesla before I have to even think about this, if we're right.
We're predominantly a pure e-commerce play, and we've seen a lot of data coming out in the past quarter where customers are actually twice as likely now to transact online in terms of buying a used vehicle. So we believe the market is really coming our way. That creates a tailwind, and that's yet another reason why we're kind of entering the public markets now.
So if you and I were sitting across your kitchen table, we're looking at a globe, but there's a mural painted on it. We could both describe it. We could describe it vividly and accurately, but our descriptions by definition would be different, right? It would be different based on our positions. It would be different based on our interpretation. And the only way that we could, in a sense, have the full benefit, as opposed to having an incomplete view, is to have that diverse exchange. Now assume in that same thought exercise, Tyler, either A, I'm not even at the kitchen table, or B, I'm at the kitchen table, but you have all the decision rights and you haven't invited me into that process. And so what we've done differently is we've been committed to inviting people into that process, to creating opportunities. We have more work to do, but that's how we've gone at it.
All right, let's zoom out a little and take a look at how the economic effect of one piece of the coronavirus puzzle could ricochet across the country's cities and counties. That one puzzle piece canceled large-scale events like sporting games and concerts. Well, more specifically, the empty stadiums that house these kinds of events. So why is that relevant to something like a county budget? Well, these stadiums cost billions and billions of dollars to build, and cities don't necessarily have all those billions sitting around in a bank account to pay to construct one of these. So they have to borrow money. All right, fine, it's normal to borrow money. They just have to pay it back, right? Well, the short answer is yes, right. And the long answer is, well, the coronavirus changed everything. CNBC.com's Elizabeth Schulze has the rest of that long answer and how this could trickle down to the residents and their wallets.
So we've all seen live concerts, live sporting events, any sort of event that gathers a lot of people together has been completely shut down over the past few months. They don't have anyone coming, sitting in their seats. And what this is doing is this is providing an additional squeeze on local and state budgets. And the reason behind that is because cities and states fund these stadiums through what are called municipal bonds. Let's talk about a little bit explaining how that actually works. So states need to borrow money to invest in a big infrastructure project like building a stadium or roads or bridges. Generally, they need to borrow money because they wouldn't have a bunch of money up front to pay for those costs. So cities and states issue what are called municipal bonds, and they essentially are borrowing money from households, it could be you or me who buy these bonds, in order to finance these projects. So take, for example, Yankee Stadium. The final reconstruction bill for Yankee Stadium about a decade ago was $2.5 billion. $1.7 billion of that funding was financed through municipal bonds issued by the city of New York. Now, the way that cities and states pay back that debt is through taxes, of course, particularly sales taxes and tourist taxes. And what we've seen is that tourist taxes have completely gone dry over the past few months. No one's coming into a hotel and paying hotel taxes or rental car taxes. And it turns out that especially for a lot of these state-of-the-art major league stadiums, they are mainly funded by these tourism taxes. So in addition to the stadiums not bringing in any revenue for themselves there, cities are having a hard time paying off the debt for those stadiums. In fact, last week we even saw the stadium where the Mets play, Citi Field. The bonds on that stadium were downgraded to junk. So not a great status there for the bonds. So one of the key questions going forward is, are states going to ultimately have to raise taxes on their own citizens in local cities or in broader states in order to make up for the budget shortfall? States, unlike the federal government, have to balance their budgets. So they have to find a way to make up for some of this lost revenue.
Now for today's numbers round. Let's kick it off with 2,000. There are currently more than 2,000 COVID-19 patients hospitalized across Texas, a record high. Before yesterday, there hadn't been that many hospitalizations in the state since May 5th, when about 1,800 patients were in the hospital. Texas was among the first states to start easing lockdown measures when its stay-at-home order expired on April 30th. On the whole, U.S. coronavirus cases have begun ticking higher since the Memorial Day holiday weekend, roughly 2 weeks ago. Next, 3.3 million. Between February and April of this year, the number of business owners in America plummeted by 3.3 million, according to the National Bureau of Economic Research. That's a 22% drop. African Americans were disproportionately affected, experiencing a 41% plunge, and the number of Latinx business owners fell by 32%. For context, during the Great Recession, business owners decreased by 730,000, a 5% reduction. And finally, 25,000. Up to 25,000 retail stores could close in 2020 as a result of the coronavirus pandemic, according to tracking data from CoreSite Research. This would be a record number of closures. Until now, the most stores closed in a year was 9,300, and that was in 2019. Bankruptcies have already begun in the retail sector. J.C. Penney, Neiman Marcus, and J. Crew have already filed for bankruptcy, and CoreSite expects more will follow. That's it for After Hours. Stay up to date in real time with CNBC. AMC Entertainment came out with quarterly earnings this afternoon. CNBC was on the conference call with executives, listening for one big thing. How do these guys plan on opening movie theaters back up? And what does that process look like? Get the latest on the economy's path to reopening by going to CNBC.com and downloading the CNBC app. We'll be right here in our home office every Tuesday and Thursday with a new edition of After Hours, so be sure to catch us then.